Hello, and welcome to today's Wealth Management Real Estate webinar, How to Hedge Inflation and the Volatile Market with Self-Storage. This webinar is sponsored by Reliant Real Estate Management. I'm David Bodemer, the Editorial Director for Wealth Management Real Estate, and in a moment, I'm going to be turning things over to our speaker. But first, I'm just going to go through some housekeeping items so you can get the most out of this event. To improve your viewing and listening experience, you can move your webcast windows around by dragging on the title bars or resize them by clicking on their lower right corners. At the bottom of your screen, you'll also find multiple application widgets. Clicking on these icons will allow you to open and close widgets on your screen, but it will not take you from the event. Also, please note that a copy of today's slide deck is available for download in the resource list widget. This webinar has been accepted for 1 CE credit hour towards the AEP designation program. And Investments in Wealth Institute has accepted this webinar for 1 hour of CE credit towards the CIMA, CPWA, CIMC, and RMA certifications. Instructions for submitting for credits are available in the resource list widget as well. We also welcome questions about today's topic, and Chris is going to answer as many as he can, both during and following the presentation. So feel free to submit your questions to the queue at any time. You can type those into the Q&A window in the left-hand side of your screen and hit that submit button. Also note that today's session is being recorded and will be available for on-demand viewing following the event. Simply log in using the same URL that you're using today. With that, I'm going to introduce today's speaker. We have with us Chris Benson. He's the Chief Investment Officer, part of the Investment Committee, and manages investor relations for Reliant Real Estate Management. In 2021, Reliant was named the 27th largest self-storage operator in the U.S. Over the past 5 years, the Reliant team has been responsible for over $1 billion in self-storage transactions across the southeastern U.S. In addition, we have another team member on the line, Dominique Rodriguez, who works in the investor services team, is going to be helping manage questions as they come in during the presentation. You can find more information about Chris by clicking on the speaker bio widget at the bottom of your screen. With all of that out of the way, I'm going to hand the floor over to Chris for today's presentation.
Well, I appreciate it, David, and thank you for everyone who's joined. As David mentioned, I'm Chris Benson from Reliant Real Estate. Excited to be with you today and share some information on what we all think is a pretty exciting time in the economic cycle. I'm certainly biased as to how I think there's some upside attached to it, but excited to talk through that with you. One other thing I would say is if you do have questions throughout the presentation, please feel free to add those to the Q&A box. Dominique will interrupt me so that we hopefully don't hear me droning on for an hour. I want this to be as interactive as possible with the groups that are participating. So please feel free to enter those questions into the Q&A box, and we'll try to get them addressed as we talk about the topic. So just one quick disclaimer, and obviously this is not for you to read right now, but when we make projections and when we talk about what we believe the future to be, obviously this is all based on our best information that we have at the time. And we have a lot of assumptions that we include in our models and what our future modeling looks like. So, just verify the information we're providing is valid with your tax professionals, wealth advisors, CPAs, and potentially attorneys to make sure it fits with your particular thesis and your belief system. And with that, let's just jump into the agenda. Here's what we hope to cover today. So I'll do a brief introduction to who Reliant is, so you have a little bit of sense of us as a company and what we focus on. We're going to talk about trends with inflation and market volatility. I think, for many of you who are on the webinar who are wealth advisors, I imagine this is something you talk about almost daily with your clients. We do too with our investor base. So we can talk about what we see there. And we're going to talk a little bit about how real estate can help hedge some of the current market conditions and some interesting things we think that make real estate a really a great opportunity in a market like today. And then obviously within real estate, we are biased, but we focus primarily on commercial self-storage. So we'll talk about some of the trends in self-storage, historical performance, why we think it's a great inflation hedge, and performance of the asset class during a recessionary period in the previous cycles. We do have a current fund we're raising equity for. We'll touch on that high level, what the fund is for any of you who find the story to be compelling and are looking for opportunities to deploy into the self-storage arena. We'll give you a high level overview, and then obviously Q&A. We'll hit on as many of those as we can. And as I mentioned, I'd love for you guys to be able to introduce those questions during the presentation so that we can hit on them while we're talking the topic and help break up the presentation a little bit. So let's just start with who we are. Reliant Real Estate Management is a vertically integrated self-storage operator, meaning we buy and manage self-storage properties across the Southeast. I'm talking to you from our office in Roswell, Georgia, which is just north of Atlanta. And I'm going to put a precursor. I was talking to David about it before we went live. It is August when we recorded this in Atlanta, and it's hot, and we have thunderstorms pretty much every day. So if for some reason the power gets knocked out, I'll dial in as quickly as I can to try to recover. But knock on wood, right now, where I don't hear any thunder in the near term. So we'll hope for the best there. We're the 27th largest self-storage operator in the United States through 2021. We have actually today we closed on properties number 77 and 78. So we have a little bit larger portfolio, valuation over $1 billion. In the last 5 years, from buy sell side, we've definitely transacted over $1 billion in storage. So we have a lot of experience, deep experience in the asset class. We really like self-storage. Our track record is here. I'll touch on that a little bit later in the deck, but we've had a really good run in the last 10 years in self-storage, never lost investor principal, and we've had a tremendous rate of return for our investors along the way. Part of that has been our doing, and part of that has been, market conditions have been there. We've had tailwinds that have helped push us along as well. So we have a great team, a highly experienced team with an intimate knowledge of the asset class. These are just some of the senior leaders on the team, and we're super grateful to all be rowing in the same direction. Everybody with a unique experience set and what I would call superpower when we bring those to the table on the Reliant side of things. But look, when we talk about any type of partnership, it's really partnering with people, and you guys who are wealth advisors know that your clients are coming to you and really betting on you as people first. The investment is certainly secondary. So we're grateful to have a great team. And, we've had two funds previous to the third fund we're in now. And Fund 1, we actually have sold in the first 2 years that we had it. Average returns were just over 30% a year. And then Fund 2 is still being operated at this point. We're 42% above our projections. So it's doing really well. And I'll talk a little bit more about how we try to structure our funds for our investors. But just to give you a sense, we've had a lot of experience in the space and working with investors to understand how to deploy capital efficiently in the market. So let's jump right into the 2022. So it's August 9th as we record this webinar. And look, the headlines have been, I think, the same for at least the last 6 months. The big one, obviously, is inflation. The chart that you're looking at here is obviously showing that inflationary rate from the growth of that inflationary rate from February of 21 through January of 2022. There were a lot of headlines on, CNN and all the 24-hour news cycles around 40-year inflationary highs. And we're feeling that everywhere, right? At the gas pumps, in the grocery stores, across the economic spectrum. I think everybody's... although very early on from our political leaders, we probably didn't get a clear picture of what inflation really looked like, but we're certainly experiencing it right now. And so, this is part of every economic cycle, and there's been certainly inflationary environments in the past. And typically, the Fed has a few different tools to combat that inflation. And you, as sophisticated investors, know what the big one is, and that's interest rates. And so, the Fed has slowly but turned on the aggressive interest rate hikes, through 2022. On January 27th, they raised the internal borrowing rate another 0.75 percentage points for the second consecutive time. We'll see what happens here in the Fed meeting in September. I believe they meet in September in Jackson Hole, and they'll make a recommendation. From everything that I've read, they're looking at another aggressive rate hike in September. and then potentially seeing what the impacts of that are on both inflation and the economy to see potentially what has to happen next. But look, we all realize that there's been some really aggressive rate hikes, and when we look at it across history, some aggressive rate hikes since 1994. The last time we saw this was, pre-Great Recession. And so it's creating an interesting market. It's definitely, we'll see what happens if it does slow the growth as the Fed hopes. But right now, I think what the Fed is trying to protect against is what we're seeing here, which is the potential of a recessionary period. And so this chart, I just want to share with you. I always find this really interesting. Essentially, what we're looking at is U.S. Treasury yield curve. And what we're looking at on the yellow highlighted areas is essentially when we see an inversion, right? Where short-term rates are moving up close to or potentially higher than the long-term Treasury rates on the 10-year. So if you look at those yellow highlighted spots, those are the areas where we've seen an inversion. And that gray bar represents a recessionary period that followed. And so you can see generally anytime we get an inversion, there's a recessionary period to follow, right? And unfortunately, I apologize, the dates are cut off a little bit down below. But if we follow this chart to the right, we're looking at an inversion and in early 2020. And then we are, as of August 4th, we are very close towards spiking towards an inversion here. So, if you believe in the historical economic cycles, I think it's a fair point to argue that since, World War II, every yield curve inversion has been followed by a recessionary period of 6 to 18 months. So arguably we're headed into a recessionary period. And look, the equities markets have reflected that, right? The S&P 500 dropped 20% in the first half of 2022, arguably the worst first half of the S&P 500 in the last 50 years, which is it was funny when I was walking through the slide deck and I said 1970 to 2022, that's 52 years. That's a long time. And so I think the equities markets are correcting, right? They are concerned about this recessionary period. And look, for all of us who are on the call, who are out there seeking alpha, right? We're all seeking yield opportunities for ourselves and for our clients. The question is, what should we be doing? And so I'm going to turn it over for anybody who's on the call who's probably, 40 years or older. You may know who they are. I'm going to ask someone to put in the Q&A box. The first person wins. We'll have to find a prize for them. But in the Q&A box, who is this person? And I'm going to give it 1 second pause before I tell you. So the question really is, well, what do we do? And look, this is Bobby McFerrin. He sang a song called "Don't Worry, Be Happy." Interestingly, when you do some research, Bobby McFerrin was not a one-hit wonder. He was quite accomplished in many different opportunities in music, classically trained. The "Don't Worry, Be Happy" pop sensation was sort of a unique one-off for him. So I'm going to change it a little bit from "Don't Worry, Be Happy" to "Don't Worry, Add Alternatives." And so, look, we're in a market where the equities, obviously the equities market are reacting and there's a correction. And for those of you who've, deployed in that traditional 60-40 asset allocation, I'm sure your portfolios have felt that change in the first half of 2022. And so what I'm suggesting to you is there's a better way and some other opportunities in this market to create some yield. And specifically, let's talk about why real estate is one of those options. And so, when I think about investing in how our investors view the world, generally, people want to understand, one, historically, how has it performed? Generally, historical performance is a great indicator of what's going to happen in the future. Second, are there tax advantages? And then third, what most of our investors come to us with is, look, what they are chasing is a low correlation to the traditional equities market. And so let's take a dive into each of those pieces and try to understand if real estate checks those boxes. So This is a data set that I really like. And we can actually add this to the library. I'll take a note. We didn't do it originally in the resource section, but if you Google the rate of return on everything, you'll find it. This paper was done by a group of Fed Reserve employees that was published. And essentially, they were trying to answer one question, which was, what type of asset class provided the best rate of return? And they did some really interesting data mining to come up with what I feel is a pretty good data set. It was across 16 countries. And these aren't developing countries. These were, what we call advanced or stabilized countries. They excluded some the periods of the wars, and also excluded, they included the period of the wars, but excluded the periods of hyperinflation that generally followed the wartime. And then essentially what they looked at was, okay, over this 125 years, what asset classes did the best, right? And they looked at housing, which I'm going to equate to real estate, the equities markets, bonds, and then, Treasury bills that in each country, obviously that looks a little bit different, but in the US, that would be Treasury bills. So, what we saw was, interestingly, housing outperformed equity, but they were pretty close. And if you look post 1950, actually equities outperformed the housing market. But here's the piece of information that I think is most compelling. So generally, from a real return standpoint, the return is about the same, right? Housing performed a little bit higher, 7.05% versus 6.89 on the mean return. But the piece that stood out to me was the standard deviation. So on the equities market, standard deviation was more than twice what the housing market was. And so what that means is essentially we had a very similar, if not better, return with much less volatility in the marketplace. And so, for me, what I took out of this paper, and obviously everyone can make their own conclusions, but asset classes with generally same return profile, but volatility in the real estate market much less than we saw in the equities market. And so this kind of contradicts one of the basic assumptions of any modern investment thesis, which is your higher risks should come with higher returns. And in our case, that isn't the case, right? You have essentially double the risk in the equities market from a timing standpoint, with generally the same return as another asset class that has much less risk. And so in a market that we look at today, does real estate provide an opportunity for you to hedge? And I think you're seeing that in many institutional investors. What we've seen is a big shift in both the advisor community and the ultra high net worth in the allocations that people are putting forward towards alternatives. Generally, I would say if you looked at like the endowments and pension funds, that 10%, 10 to 15% is generally the place that we see allocation to alternatives. We met with an advisory group here in Atlanta last week where they're seeing some of their ultra high net worths in the 40% range on the alternative side. Obviously, real estate only being a part of that, but we're definitely seeing a shift to the alternative space for the reasons I think we're seeing here, right? Is there are some better options that maybe non-correlated to the market, offering some diversification versus the traditional equities market. So if we're saying historical returns, real estate has done really well. Another advantage that we see and many of our investors see for real estate is the ability to create some tax advantages around the income received from that real estate. And so for those of you familiar with depreciation, essentially the IRS allows you to depreciate the property value on a schedule, and generally long schedule, 27.5 to 39.5 years. And what the IRS is saying there, right, is, look, you have a building and we know that each year the building's going to be worth a little bit less. The roof isn't going to be as valuable, the sheetrock, the fixtures, et cetera. And so it allows us to take a loss each year in real estate, and that loss can help offset the income you're receiving. And so what that means, from an investor standpoint is you can generally create a passive income stream that can be offset with the losses. So for the IRS standpoint, it looks like a zero or a net loss for the year, even if you're receiving that taxable or that income from the property. So, there are some nuances around depreciation, and I would encourage you to talk to your tax advisor about it for sure. And there are also some ways you can accelerate depreciation. There are bonus depreciation or cost segregation studies essentially allow you to pull forward certain things in real property that depreciate on a quicker schedule than the traditional IRS schedule. And what that allows us to do is create more front-end loss. And so some of our investors are trying to build their strategy with investing with us or other real estate opportunities where they're using those losses to offset other gains. I'm sure many of you on the call are familiar with opportunity zones and the opportunity to defer tax there. Many of our investors are using depreciation as part of that strategy to offset other gains as well. So, I think there's some unique tax advantages that real estate has on the tax side of things that traditionally our equities markets don't offer. And then this one, boy, this is, in my opinion, probably one of the greatest wealth preservation tools in the tax code today. This is 1031 exchange. And so one of the unique things with real estate in the current tax code as it stands, our politicians have been, trumpeting that they potentially will take this away, but it's existed for the last 125 years. And my expectation is it will probably exist moving forward. But 1031 exchange allows you to buy real estate, and if you sell it at some point in the future and realize a gain, you can defer paying the tax on that gain by exchanging your profits into a like-kind property. So, let's say I have a house and I sell a rental house and I buy it for $100,000 and 5 years later I sell it for $200,000. The IRS allows you to take that $100,000 in gain and roll it into a like-kind exchange. And it doesn't have to be, if I own a single-family house into a single-family house. We have many investors who come to Reliant saying, hey, I sold an apartment building, I have $1 million, I want to exchange it into a self-storage property. That like-kind exchange is a pretty broad definition, but it allows you to defer that tax so that you can essentially kick the can. And now you're earning a income on your gross proceeds, for lack of a better term. Currently there is no limit to how many times you can do this in the tax code. So, many ultra high net worth people, you may have heard the term defer, and die. And the reason why they do that is you can 1031, let's say you pass away, that exchange or that property comes into the estate. And when it goes into the estate, you get a step up in basis. So the heirs of the estate or the beneficiaries of the estate essentially they start at zero. So there is no taxable gain for them ever. Now, tax code certainly could change, but this is a really powerful tool that exists in the real estate asset class. And in self-storage, obviously, we try to do this and create those tax efficiencies the best we can for us, our investors. And, in my opinion, again, probably one of the best wealth preservation tools that exists in the space. All right, so the last checkbox for real estate, low correlation to traditional equities market. So since 1990, the average 5-year rolling return correlation between core real estate and large cap stocks was 0.56, 0.67. So relatively low correlation compared to what I would say traditional equities. And that's because, look, when inflation is running rampant or we're seeing a recessionary cycle, our values in real estate, in commercial real estate, are predicated on net operating income, or for another term, not net operating income, profit, right? Profit before you pay your debt service. That profit isn't always affected by traditional economic cycles. Sometimes it is, but generally, and COVID, I'll dive into that with self-storage. COVID for self-storage was a huge boom. And as the equities market was fluctuating up and down, we saw nothing but growth because our profitability at these sites was growing. And so, we have that nice non-correlation between the two. And so for clients who are looking for that diversification between the equities market and some alternatives, real estate offers a really nice option there. And then last thing is, I'm just looking at 10 years. The chart's showing a very nice higher income stream than on the equity side. So if you think about it versus dividends, 10-year Treasury coupon, or the S&P dividend yield, generally real estate has the opportunity to produce a really nice income stream along the way for investors during the hold period. So look, I feel like it's been it's a compelling reason as to why real estate. It's a nice alternative in a market that we're currently in, where ostensibly we can get some great historical returns, have some tax advantages along the way, and then some, non-correlated assets to kind of offset some of the volatility that we're seeing in the marketplace. So, what you may be asking is, all right, Chris, I get it. Real estate makes sense, that there's probably an allocation to be made. Why should I think about self-storage? And I'm going to touch on 4 things that our investors talk to us about almost every day. I don't want to say every day, but pretty much every day. If there are any questions at this point, Dominique, I'm just going to turn it over to you really quick. Are there any questions you think we should address before we get into the self-storage component?
Certainly. So we really had one in particular question from a caller that kind of jumps back to the inflationary discussion that you were going through. So specifically, what is your forecast for the effects of the recently passed Inflation Reduction Act, specifically the increase in the IRS budget, and then the addition of thousands of IRA audit agents?
The last part, did you say thousands of IRS audit agents?
IRA audit agents, yes, and I'm happy to reread.
Yeah, so look, as far as my prediction, I have an opinion. I would say that my predictions are, I don't want to say 100% wrong, but there are a lot smarter people than me that will read that bill and make a prediction. From my perspective, and I've read probably what you've read, kind of the summary that was put out in the New York Times this weekend, and the Wall Street Journal had a little blurb on it. I think as the weeks pass, we'll have some more understanding. But I think generally what will happen is, and again, my opinion is overlaid in this heavily, is interest rates will continue to rise through the end of the year. I think it will slow the economy somewhat. Whether we enter the definition of a recessionary period, I think we're already there. And generally, you don't know you're in a recession until you're already in the middle of it. But from my perspective, the Fed will do what it's trying to do. But as we head into the next political cycle, my opinion is there will be a shift, and the goal will be to grow the economy again. And with that will come interest rate cuts and some cheaper money in the marketplace. And ultimately, this is a blip in a higher interest rate environment. Now, I could be completely wrong. It's just my interpretation of the so-called tea leaves. And I think the Fed is starting to see the impact of the interest rate hikes. The recently passed bill this weekend, I'm going to give that a few more weeks. I don't by any means believe I'm an expert in that to understand where that impacts. But I do think we are going to head into a period of, 6 to 12 months of slower growth than probably what people are going to want to see. And there's going to be an impact on that. Consumers are tapped right now. If you look at, borrowing or savings rate versus credit card debt, that shift from COVID, where we had a lot of savings, not much debt, is starting to go the other way, which is where we see consumers tapped. So we'll see what happens, but I generally think this is a shorter term play. The Fed ultimately relents, interest rates go down. Look, it's August 9th of 2022. In January of 2024, we can go back and listen to this and see how close I was. Maybe we'll do an email or an article about that, but we'll see what happens.
Right.
Dominique, anything else?
Yes. So while we're kind of speaking on those interest rates, do you think the raising interest rates will cause a drop in real estate prices?
Yeah, it's an interesting question. So historically, interest rates, and for those of you guys not familiar with cap rates is really just a measure of the market demand for a particular asset class. And generally, interest rates and cap rates move together. So if there's a period of rising interest rates, generally cap rates rise, which means values go down. And what I would argue is what we are seeing, and I can really only speak to self-storage because that's what I know the most, we are not seeing a shift in values yet. Interest rates are definitely rising. So when we're going out and getting debt, the rates at which we're receiving our debt are much higher. Well, not much higher, but I would say within 100 basis points of potentially what we were seeing 6 months ago. But historically still pretty low relative to, some other inflation or some other high interest rate periods. And we have not seen the correction yet where buyers are saying, all right, we're going to adjust value for that increased cost of money. And why I think that's happening is there is so much capital chasing yield right now, and still dry powder from, the COVID period where people expected this big correction in real estate and had all this capital to deploy. It still needs to be deployed. When you think about groups like Blackstone, who's raising $2 to $4 billion a month in their BREIT fund, what that means is that capital has to go out the door. And so it goes out the door into projects or properties like self-storage. And, we are not seeing that correction. We're seeing rising borrowing costs, but we're not seeing that adjustment yet in values. It could happen. Again, my personal thesis is there's too much capital in the market. And specifically in self-storage, people believe it's a very recession resilient asset class. And so if you are an institutional investor who believes that self-storage is recession resilient, and we're headed for a period of recession resiliency, headed for a period of recession, generally they want to deploy capital in that space. So you have a lot of cash chasing these deals. So Dominique, that was a long way of answering a short question, but we have not seen that correction yet on the value side of things.
Right. Let's jump back to our 1031 discussion. Can you revisit that specifically? How will the funds take advantage of a 1031?
Yeah, so it's a one-off situation. In our case, we're generally trying to find unique ways to create tax efficient. I don't want to speak specifically for our current fund because it's in its infancy. We haven't closed it yet. And every liquidity event we have, we're trying to create a tax efficient structure. So I can't speak about specifics, but generally we're trying to find a way to tax efficiently move, any gains that we've created for us and our investors to another like-kind exchange. For us, it makes sense because it's going to help investors recycle their capital with us. And then certainly, for ourselves, we've created equity in these projects and we want to roll that forward as well. So I don't want to give you an exact, because our fund is projected to be a 6-year hold and we're not even in year one yet or done with year one. So, what happens at the end is a little bit up in the air, but we're going to do our best to create some tax advantage for us and our investors.
Wonderful. Well, we certainly appreciate those questions that have come in so far. We can certainly continue our discussion into why self-storage.
All right. Thanks, Dominique. So why self-storage? We talked about the real estate side. And, I think for the self-storage piece of things, we feel very much the same way. Historically, it's done very well. I'll share some data with you on that. The downside protection during a recessionary period, we feel like is historically has performed very well in recessionary environments. We think there's a unique consolidation opportunity in the space, and that's what Reliant really is working on. And then, one question we get asked almost every day is, how did self-storage perform during COVID? Again, depending on where you are in the country, COVID is more or less relevant. Here in the South, obviously, COVID seems to be gone away, but I have family in the Northeast where COVID still we seem to be in the thick of it. So I don't know if it's over or not, but we'll certainly share how the asset class did. So let's think about those three things we talked about: the historical returns, the downside protection or recession resilience, and then the market consolidation opportunity. So I'm going to reference a data set, and you can see it at the bottom of the slide, I believe. This data is from the National Association of REITs, and they track all of the publicly traded REITs across all asset classes. So if there's a real estate investment trust in a particular asset class, they're tracking it. It's public. So according to the National Association of REITs, self-storage has done just over 18.8% over the last 28 years. Now, that's an incredible number, and it's outperformed some of the core four that everybody thinks about, when you think about real estate. Apartments, which did 14%, great return. Retail, freestanding retail, 13.5%, also great. Office, 12%. Industrial would be the fourth. I don't have that data up there, but industrial's done very well over the last 28 years as well. But look at the S&P 500. Over that same 28-year period, the S&P did 8.4%. Now, I ran a little math, and it's not in the slide deck, but feel free to run this yourself. If you take 18.8% and compound that annually over 28 years, if I invested $100,000 and I took that 18% compounded annually today, after 28 years, I invested in 1994, and 28 years gets us to today, that's just over $10 million. Not too bad. If I take that same 100 grand and I put it into the S&P 500 over that 28 years, I end up with just under $1 million. So almost a 10x multiple, and just shows the power of real estate over time. Historically, self-storage has done very well. And I believe that everything in the economic world is cyclical, right? So, if it's going to happen, it's probably happened in the past. And so I believe just like there's going to be a period of economic rise, there's going to be a period of economic decline. We've seen a few of those in the most recent future, right? Great Recession, 2007, 8, and 9. Storage did very well comparatively, down 3.86% through those 3 years. Apartments just under 7, retail a little bit harsher, right? 12%, office 8%, S&P 500 was down 21% during that 3-year period. So, storage, we talked about that when we went back to that paper, less volatility than potentially we see in the equities market. In 2020, self-storage outperformed all other asset classes versus data centers. It was up almost 13% in 2020 despite the pandemic. And I'll go into a little bit more detail around why I think that is. But so in the last 2 recent economic cycles, storage has done really well. And then the last piece, we talk about this market consolidation opportunity. So there are 6 publicly traded companies in the space, names that you'd recognize. So Public Storage, Extra Space, CubeSmart. If you're driving on a highway and potentially listening to this, hopefully you're not watching it. But if you look off an off-ramp, there's a pretty good bet there's a self-storage facility off one of those major highway off-ramps, and it's got one of those names on it, Public, Extra, Cube. They own about 30% of the market, and by square footage. That's how we're measuring that. So there's a very large roll-up or consolidation opportunity in the space. And companies like Reliant, that's what we're working to do. And the reason is because there's a very large appetite for institutional money to deploy in self-storage, but they have to do it at scale. So Blackstone is a great example. In 2020, they bought a self-storage company very similar to Reliant. It's a company called Simply Self-Storage. And they bought that company, not just the properties, the whole operational company. And the reason they did that is they wanted the properties, but they also wanted the ability to deploy capital in the space. And now they have their own operator to do that with. So there's very much interest at that level, but that was a multi-billion-dollar transaction. And it's hard to create that scale in a portfolio. So that's where we see our spaces roll up as many of these mom and pop operators as we can. And potentially there's a liquidity event in the future for us and our investors. So those are really the 3 reasons we like self-storage. And then, we talked about a little bit about the performance during the pandemic. Let me give you some specific data. So again, this is the National Association of REIT data. And what you're seeing on the chart to the right is the orange bars represent 2021. The blue bars represent 2020. So if you take a look, let's look at 2020 first. Self-storage did just under 13%, as I said, outperformed by data centers, which makes sense, right? In 2020, everybody was doing online e-commerce, which funds like Amazon and companies need space for their data rooms. And so there was a huge demand for data centers. So that would make sense. They did really well. Retail got crushed, right, in 2020, as you'd expect. Nobody was shopping. So everybody, fell off that bandwagon a little bit. From an office standpoint, people were working from home, right? So the office lost 18% in the REIT space. Industrial did very well. Again, e-commerce, right? People are bolstering their inventories, and so they need the space to keep it. And so, storage did very well during the pandemic, and even better in 2021, and outperformed all other asset classes. And the question is why? And this is the key part of storage from a recession standpoint. When you have transition in your life, generally you're using self-storage. So we use the 4 Ds of self-storage demand, and that's death, dislocation, downsizing, and divorce. If those things are happening in your life, generally you're consuming self-storage. And during 2021, unfortunately, a lot of people were passing away. A lot of people were moving or downsizing, right? All of a sudden, work from home, people are moving all over the country. And interestingly, the divorce rate in 2021 was also very high. It turns out if you take 2 people who don't really like each other and put them in a room together and make them stay there, that doesn't last very long. So we really had the benefit of that demand driver in self-storage. And so, if I was kind of to land the plane on why self-storage, it's really the historical returns, how it's performed in recessionary downturns, and then certainly the consolidation opportunity that offer what I think is, there's some benefits to investing in real estate, and then specific to storage in real estate, I think there are some really strong benefits, especially in the market that we're in today. One other thing I'm going to add about storage, when we think about inflation, storage is uniquely positioned in that we have 30-day leases. So different than, let's say, apartments or let's say office, where they have a much longer term lease, right? An office lease, 3 to 5 to 7 years is pretty typical. Well, in a recessionary period, or in a inflationary period, those long-term leases can be problematic because you can't adjust prices up as the market adjusts. With storage, we have a 30-day window. So theoretically, we could raise prices every month. Now, we probably wouldn't have many tenants left if we did it that way, but we have the ability to raise rents on a monthly basis. And so it gives us a lot of flexibility, especially in an inflationary environment like we're in today. So I'm going to shift gears, and I'm going to open it up to Dominique for questions one more time. And then we'll get into, look, if you feel compelled by real estate is an interesting alternative investment, and self-storage within real estate is an interesting opportunity, I'm going to share with you a little bit of information on our most recent fund to give you a sense of how we structure investment opportunities for our investors, so that they can deploy capital in the space. So Dominique, let me turn it over to you one more time. Any questions you think we should address before we dive into the fund details?
Not necessarily at this point, but we can go ahead and dive into the fund and Reliant.
All right, sounds good. Well, so we are currently raising an equity fund, Reliant Self-Storage Fund 3. It was targeted originally at $100 million of equity raised. We're actually going to be at about 115 when we close it. So we're a little bit over because we had more properties than we thought. But it's a projected 6-year hold period. And the goal is, think of it as a mutual fund of self-storage properties. We're trying to buy as many value-add self-storage properties, put them in a portfolio, and allow investors to reap the benefits of a diversified portfolio that produces passive income on a quarterly distribution basis, and hopefully produces capital appreciation over our 6-year hold period. So generally what we're doing is we're buying an existing asset. The perfect scenario for us is a mom and pop owned facility that has some additional land, and potentially they've owned it for 20 years and there's some deferred maintenance there. They haven't capitalized on expansion opportunities in their market. And that is a perfect deal for us. So generally, we're trying to buy an existing asset, find some way to add value to it. Generally, that's construction. So we add additional units, and then we get those leased up. And that's where we get our profit growth from. And that's in that revenue enhancement We're doing some other things too, like adding U-Haul truck rentals, tenant insurance programs, what I would consider ancillary revenue items. And then we're looking for some liquidity event. We've typically sold our properties after we've created values to some of the REITs, the real estate investment trusts, institutional investors like groups like a Blackstone, or we've had some institutional investors come to us and recapitalize our investors. So they essentially buy our investors out of the deal. So the fund has some projected returns. I'll walk you through those. And keep in mind, these are all based on our assumptions and what we've done historically. But the fund is projected to produce a 4 to 7% cash-on-cash return on an annual basis. And those are paid through quarterly distributions. And then when we sell, we expect the total ROI to be between 72 and 90%. So let me walk you through a specific example if $100,000 were to be invested in our fund. We expect to pay out between $4,000 and $7,000 per year during the hold period. And that's on a quarterly basis. So let's just say $1,000 a quarter. And while that's happening, we're hopefully building the value of these properties up. So as we build, the cash flows hopefully increase, from 4 to 5 to 6 to 7 as those value add projects are executed on. And then we look for a liquidity event. And in this case of $100,000, we expect to receive $48,000 in profit. So an investment in the fund would project to return $72,000 to $90,000 in profit. So $100,000 in, 6 years later, including the quarterly distributions, net of all fees, we expect to return to our investors between $172,000 to $190,000, which works itself out to be about 12 to 15% a year on an annual cash-on-cash ROI. So hopefully that's clear. And again, these are projections based on assumptions, and it's very challenging to predict the future, as everyone on this call knows. And so, the big one being, someone asked the question earlier in the webinar about cap rates or values. Are values going down as interest rates rise? Not today. We underwrite that values go down for each year we hold a project, but that may not happen. Or it could happen more than we underwrite. We really don't know. And so our job really as a sponsor is to build more net operating income. If we can do that, that's like building EBITDA in some of your wealth advisory businesses or AUM, right? If you can grow your AUM, generally your business is worth more. In self-storage and commercial real estate, if we can grow our NOI, all other things being equal, it's worth more. And let's say values do drop 6 years from now, but we've grown NOI. Well, then our cash flow, if we've grown NOI, the properties are producing cash flow. So maybe they're clipping a 6 to 7 to 8% a year coupon, and values aren't there. We'll say to our investors, guys, now's not the time to sell, but let's collect these coupons while we can. So that's really the key, is growing the net operating income. So I'm going to highlight a couple things on this. Yep.
Hey there. So before we jump into the terms of the fund structure, we did have a couple of questions pertaining to strategy and what we're seeing in the self-storage market. So as you mentioned, there has been a lot of consolidation in the storage sector, and you expect opportunities to continue. Market values for sales of storage facilities recently have been very high. So will things be overbuilt in 5 to 6 years? And then there's a second part to that question as well. Who will you sell to at the end of the term, and do you expect it to be at similar levels than compared to now?
Yeah, two great questions, Dominique. So let me take the first one first, which is, I think that the theme of that question is, will we overbuild in the market? And the answer is probably. We in real estate are really bad at knowing when to stop. If people have made money, they can just continue developing. What I would say about storage, unique to maybe some other asset classes, is we are very micro market. So think about storage being a small addressable market. We used to look at 1, 3, and 5 mile radii or radiuses around our facilities. And we've more recently stopped doing that and looked at drive time. So, 5-minute drive, 10-minute drive, 15-minute drive. And what we're trying to understand is, look, storage is a garage, right? It's a heated or air-conditioned garage or not. There's no magic. And so people aren't going to drive for a garage. It's got to be convenient to either work or home or some other reason that they go to that facility. It's not like apartments where school districts or maybe they have amenities, a pool or a gym, and so the people will drive to that apartment community even if it's a little out of the way. So my point in saying that is, excuse me, yes, there will be markets that are oversaturated. And historically, we've seen some of those. We've been in some of those markets. But there are always opportunities in those micro markets. And that's what our acquisitions team does a really good job of understanding is, what are the drivers for that 7-minute drive time? Why would they come to us? And what does the competitive set look like around it? Are there some barriers to entry so new people can't come in? So what I'm saying to answer your question is, there will be some markets that get overbuilt. And I'll give you an example. We actually have an article in our website. It's called The Worst Deal Reliant Ever Did. Maybe we can add that, Dominique. I don't know if the ability to put that on the Q&A for other people to see the link is there. But what it allows, basically it tells the story of a deal that we did in a market that got overbuilt. And so within 2 years of us owning the site, we had 3 brand new competitors within a 2-mile radius, and it crushed us, right? We were all building at the same time. We were all trying to fill our units. So what happens, right? Oversupply, rates drop. So everybody, it's a race to the bottom where rental rates are much lower than we projected. But here's the upside. Eventually, we all got full and rates came up. And it's just a question of timing. Now, in that particular deal, we had an institutional partner who wanted to sell. So in our opinion, they sold too early. But we didn't make the decision on that one. So it certainly can happen. We're really focused on finding markets where we think it's undersupplied. So long answer to a short question. And then, Dominique, the second question was, what do we think values could potentially be 6 years from now?
Correct.
So we have no idea.
And who would we sell to at the end of that term?
Yeah, great. So first, on the sale piece, I can only go to what's happened historically. We've sold to the real estate investment trusts, the publicly traded companies. We've done a lot of business with CubeSmart. They've probably bought close to $200 million worth of our stuff over the last 3 years. And then institutional capital. So companies, think of like pension funds, insurance companies. They are trying to deploy in the space. But again, they need a big enough scale where it makes sense for them. So if I run a $200 billion pension fund, deploying $100 million doesn't move the needle, but $500 million might move the needle. So they need big transactions to make it make sense. And that's where we feel like the consolidation play makes sense. And to the second part of that question of where do we think values will be in 6 years? No idea. Predicting the future is a silly endeavor. And a fool's errand, in my opinion. So all we can do is this modeling that you're seeing here is based off us saying values will be worse each year we hold it. Cap rates will rise and values will go down. Now, that might not happen. And if it doesn't happen, great. We all make a lot more money. But these projections are based on values going down for each year. So arguably, we are about 100 basis points below where we think values are today. So we're saying in 6 years, cap rates will be 100 basis points higher and values will be that much lower. Now, again, back to my disclaimer slide, complete and utter projection. We have no idea. And if anyone on the call knows how to predict the future 6 years from now, please tell me. We'll all make a lot more money than we will in self-storage. But we just try to hedge that by underwriting values or cap rates going up and values dropping for each year we hold it.
Wonderful.
Any
Thank
more,
you, Chris.
Dominique?
Not at this moment. I do know that we are at 255, so we can dive into the terms of the offering, and then if we have any last-minute questions, we're happy to address what we can.
Perfect. So there's two things I want to hit on the term sheet, and I know there's a lot on this slide. So hopefully you can download the pitch deck from the resource library, and you can dig into this at your own time. Our website has a webinar where we walk through this in more detail. But we talked about what the plan of the fund is. I'm going to focus on the fees and then the structure. So our fee structure, there are two fees that are paid one time at the property closing. An acquisition fee, which is 2% of the cost of the property, and then the investor is paying their pro rata share of that. That's paid at the closing and goes away. There's a development fee, which is 6% of the CapEx budget, which means if the project has a construction component to it, there's a budget. There's a 6% fee on that budget, and you would pay your pro rata share of that. Again, one time at closing and goes away. There are two fees that are paid out of the cash flows of the portfolio. One is an investment management fee, and that's 6.65% on equity deployed in the fund. And as the equity gets deployed, it has this fee on it. It's paid out of the cash flows produced by the property. And then a property management fee, which is 6% of gross revenues, and that really pays our property management overhead. It's our employees who run our sites. That's the fee structure. I'm going to just walk through the investment structure and a hurdle. So we have three classes of share, each with their own investment minimum. Class A is $5 million, Class B is $1 million, Class C is $50,000. I'm going to walk through the Class C share. Majority of our investors, our average investment is $120,000. So most of our investors come to us in this class of share. 8% preferred return, which means until you, the investor, get your 8% preferred return, all the capital post fees goes to you. Once we meet that 8% preferred return, we have to pay back 100% of your principal. So if you have $100,000 invested, we have to pay back your $100,000. And then any remaining profits get split 70% to you and 30% to Reliant. That's called a waterfall. And so 8% preferred return with a 70-30 waterfall. Now, there is one more level of split. If we meet an 15% IRR, internal rate of return, what happens is the 70-30 for our Class C share goes to 50-50. And what that means is we're saying, look, if we outperform, we want to share in more of the upside. And when we think about these structures, if you're looking at any real estate deal, you just want to make sure your incentives are aligned with the operator. Because we're in a partnership in this deal, you don't want us getting rich before you've gotten your money back and got rich. So how we built this structure is to try to share. You guys get your principal back, you get your preferred return, then we split, you get the lion's share of the split. If we outperform, we get to benefit in that outperformance. So again, if you have questions, I know we're going through that quickly, and it's a lot for people who may not be experienced in real estate, but we can ask those questions either in the Q&A box or we can address them after the webinar. Fund 3 through May of 2022 is doing great. We're 13% above our NOI projections. And for us, that's really the measure to see, are we able to execute on our business plan? It's still very early in the fund. Fund 3 was launched in November of 2019. We have 27 properties in it. As of today, we just closed on properties number 28 and 29. There are 29 properties in the fund, and we have a 30th property that will close at the end of September, and then we believe we're going to close the fund. So just for the purposes of time, because I know we're coming up on the hour, I want to just touch on a specific property. Here you can see where the geographic location of those 30 properties are. So we have a nice geographic diversification across the Southeast and a portfolio in Colorado. But I want to just touch on one property. There's a couple in here, and I can go through more if people would, if that's helpful. But I want to just give you a sense of what we do. So this was the first property the fund bought in November of 2021. This is in Kissimmee, Florida, just north of Orlando. Great market. It's growing, expanding. The Southeast is doing fantastic, as many of you know. And interestingly, the guy who developed this property, he built it in 2019, and it leased from 20% to 85% occupancy in 16 months, which in self-storage is an incredible lease up, right? That filled very, very quickly. And probably a testament to the demand in that market. He did a good job with his market selection. You can't see it exactly, but behind this closed badge, there's a parcel of grass. It's just the rest of the lot. What our business plan is here is we're going to build a 3-story, 33,000 square foot expansion, and essentially just Lego pieces onto the back, right on the back of the building. And we will add an additional number of units to that property. And if we can get those units leased up, then our net operating income, our profit is growing at that site. And so this is kind of a perfect deal for us. It's in a market very similar to where we have many other facilities. There's an expansion component to it, so we have that NOI growth opportunity. And we believe it's in a path of progress where Orlando, that market is going to continue to grow. So when you think about what Reliant does, we generally are doing very similar business plans in very similar markets. I have a few other examples in here, but we're right at the hour. So Dominique, I'm going to turn it over to you or David. Are there any other additional questions we should answer before? And if not, we can kind of maybe show one more property and then we'll shut it down.
Yeah, I think at this point we should just get it wrapped up. So I think you've taken all the audience questions, or at least the majority that have come in. So if you want to just finish up with the last details, and then I've got some housekeeping as well. So we'll try to get this done by 3:05 or so.
Yeah, for sure. So what I would say is if you have any additional questions, my email's on the slide that you see in front of you. I know that they have some information that gets sent to us. If you'd like us to follow up with you, we can certainly do that. Our Director of Investor Relations, Matt Blackwell, his email is there as well. Feel free to send an email directly to us with any additional questions that you may have or maybe we didn't get to, and we'll do our best to answer those. Look, if you believe in the current environment there is an opportunity for alternatives, we think there's a compelling case to be made for self-storage. We have a fantastic track record and we're always looking to expand our investor base. So if that's something of interest to you, happy to continue that discussion with you. You can reach out to us here or on the polls that the group has with you. Just let us know you want us to reach out and our team will do just that. But I appreciate everybody being patient and the thoughtful questions, and hopefully it was a valuable use of your time.
Great. Well, thank you, Chris, for that great presentation and for seamlessly incorporating so many of those questions right into your discussion. That was great. We'd also like to thank Reliant Real Estate Management for making today's webinar possible. Once you leave the event, a short survey is going to pop up in your browser window, so we would appreciate if you could share any feedback, as it does help us provide you with the best content going forward. And I want to thank you for taking some time in your day and your week to tune into this. We have more webinars and forums coming up, so keep a lookout for additional programming that we have for you in the coming next couple of months. And on behalf of Wealth Management Real Estate, thank you for tuning in and have a great rest of the day.